What's going on, guys? Welcome to the Corbin Claypool Show. Excited to bring this to you where we talk about growth, business development. And today we're going to be talking about the real estate market and the mortgage market. I got my co-host Ernesto here. We're going to be going over what's going on in the market. I'm excited to bring this to you. So let's get into this. So I wrote down some stuff that I thought was interesting. I did some research over the past couple of days for this preparing. You know, Ernesto and I, we watch the market pretty much every day. I know, Ernesto, you've been taking a little bit of a break from the market right now, though.
It was a little bit crazy. It's been going up and down.
Yeah.
So every once in a while, I think you need a little market detox.
Yeah. I know. Being a loan officer, watching the interest rates go up or down every single day in this market. And we're going to get into this because I have a pretty funny article about that. It can be a little stressful. So I agree with you, man. Sometimes you got to detox.
Yeah.
So yeah, let's get into this, guys. So we have some big stuff coming up in the market. We have the September 20th Fed meeting, which is coming out. That's going to be a big thing because it could be the first Fed meeting where maybe they keep rates the same. There was actually one Fed chair that was saying no longer is she going to try, or are they going to try to get to 2% inflation in order to reduce rates, or even up rates. So they're saying basically they don't need to up rates to get it down to 2% inflation, and they may even lower rates before it reaches 2% inflation, which is what they had originally talked about, is they want to be at that 2% inflation number. What do you think about that, man? Where do you think rates are going to come down? When do you think we're going to start getting rate reductions in the Fed market?
So I think that they've been teetering on possibly pausing or calming down a little bit for a while, but I think they're just skating on thin ice. So they worry to say it because the market reacts so quickly the moment that they kind of smell a little bit, I guess you could say, fear, a little bit of a change, and what they've been kind of going. And I think that they try to tread lightly because we've been putting so much effort, or they've been putting so much effort into try to tame inflation for so long that they don't want to lose all the progress that we've made. So it's kind of one of those things that they got to tread really, really lightly. But I do believe that we're kind of getting to the end of summer, going into the winter months, which historically speaking is a little bit more calmer time of the year. We do know that there's a big move in housing, especially in the summer, right? Because I mean, and there's different seasons when it comes to it, but coming into the summer, school started, right? It's not that easy to just move your family when school's already starting. So just the seasonality of it, and because of all the progress that they've been making, I think we're due.
You think we're due for a rate hike?
I think we're due for a calming of that, whether that's,
right.
I don't think a hike, I just think more of not so much of a hawkish tone right now. So I think it's more of just a taming of the way that they speak, and hopefully that fares better for rates. And we have seen it more recently now that they are kind of calming down. We have seen a little bit of a rally, nothing too crazy, because we did see about a week ago, and I think you can talk about that shortly, about how we did see a quick reversal and then, for the better, and then couple hours later.
Which we're seeing that every day. And to kind of point out what Ernesto's saying is the moment the Fed starts saying something good, Jerome Powell goes on and says, well, the market looks great. Or if he gives positive reinforcement, you're going to see the market get a lot better really quick as far as mortgage rates coming down slightly. The market's going to have more confidence. So they tread lightly on what they say because it's political, man. A lot of what they say depicts what happens in the actual market. And people don't understand that the stock market, the mortgage market, all of that is depicted by what's going on in the world and honestly what people say on the news, right? Anything like that. If he says something's big on the news, that can actually trigger rates coming down a little bit. Now, we're not talking a trigger of going to 3%, 4%. We have a lot of movement before we got to get there. But you may see rates come down 0.5% or 1%, even get down to the low sixes again, right? A few months ago, we were into the low sixes just because there was some positive economic news going on. So now we're back into the sevens, and we'll get into that and talk about that a little bit.
And I do think that we have seen the sixes kind of fare well with the market. I think that especially with like new home builders and things like that, they've been kind of keeping them in the sixes artificially because we have seen some positivity in that. It's when we get to the sevens and the eights is when things kind of take a little bit of a turn for the worse.
Right. And it becomes unaffordable for
exactly,
people, man.
Exactly.
I mean, that's hard for the average American buying, especially in the Fresno market when we have no inventory. It's still crazy competitive. Home prices are still being driven up, and somebody making $60,000, $70,000 a year, it makes it tough for them to purchase in this market, right? If it's $400,000, $500,000. which is now basically an entry-level home here in Fresno.
Exactly.
Right? 500 is an entry-level home now. And I remember 3-4 years ago, 500,000 got you a freaking 4 or 5 bedroom house in Woodward Lakes, right? You're in a good area. Now 500,000, it gets you a nice home, but nothing to compare to what it got you 4 or 5 years ago.
Yeah, the area median, or not the area median, I'm sorry, the median entry-level home, like you mentioned, is in the 400 range,
right?
Which with a higher rate, that can become pretty difficult for the average American.
Definitely. So just some remarks. The growth in the economy is modest. Retail spending is slow. I thought this was interesting. Retail spending has slowed, which that's obvious, but tourism is up. I wonder why I feel like people are trying to get the hell out of this market, man, or something.
Well, I think also we were kept indoors for so long that now that we're getting the opportunity to get out, we're doing it. You know?
And there's an article in here I have that, credit card debt. Here it is, actually. Delinquency rate on credit cards under 40 years old are 8% now. Delinquency rates for those under 30 are 9%. That's huge. So that means that during COVID, people were spending all this money because everybody was making so much money for the most part. Most industries were. And they got used to this life, and now they're just putting everything on credit cards to continue, right?
Especially
we're starting to see retail spending slow. The next one, consumers have exhausted savings for the most part, right? So savings is down across the whole nation.
Yeah, I think it's because there was obviously we're getting a lot of money. A lot of people were getting the help from the government and things like that during the COVID, the pandemic. So retail spending kind of went up. We're staying home, so what feels good is just spending some money, right?
Right.
But what happens is once that's cut out, how do you keep that same lifestyle? And that goes into the credit cards. Rates were low. And the issue that we're having is that now that rates are climbing, not just for mortgages, they're climbing altogether. Mm-hmm. So whereas I want to say, I read recently that the average interest rate on credit cards was about 15% during the pandemic. And now we're seeing almost double that. So now it's just getting way more expensive.
And
what does that do?
more expensive.
Yep.
Gas is more expensive. Food, grocery store, everything's more expensive. So the middle class America is getting squeezed beyond belief right now. And it's something that they're not talking about because we see on the news media, sometimes even, the market's doing good. There's jobs being created, things of this nature. There's the other side of the coin too. People are definitely against that. But I would think overall with inflation, now that it's come down, but prices are still high for the most part, and where everything is, the middle class America is getting squeezed crazy right now. Job growth subdued across the meaning that, job growth has basically come down.
And that's what they wanted, right? Because
100%. Yeah.
Because the more people are working, the more that they're spending.
Well, I think Powell said something to the point of.
And can you enlighten us on who Powell is for the audience that doesn't know?
Yeah, he's the main Fed chair, basically, right?
So whatever he says is anytime he speaks, we're listening, and his words, however tone he has it, even his basic tone is extremely market moving. But continue.
Right. Yeah. So Jerome Powell said something the other day. It was, I believe I saw an article somewhere. 2% inflation is no longer the goal, right? He did say it's still the goal, but it's not like their main focus. He said something to the effect of he wants the economy to suffer a little bit more.
Yeah.
So I think that is why we haven't seen. Sorry, Ness. Let me finish this thought here. That is why we haven't seen rates on the mortgage side come down, right? And Barry Habib's been saying rates going to come down. Back in May of this year, rates are going to come down. People weren't locking their loans. Companies lost. If we look at nationwide, mortgage companies lost millions and millions of dollars because nobody was locking their loans at the time because everybody thought rates are coming down because of, and not just Barry, but a lot of the media, a lot of different people were saying this, that inflation is going to come down, the May 10th report, yada, 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 the year over year, all this stuff. And now that we're actually seeing inflation come down and we're like, 3% now? We're almost to our target of 2%. We're still seeing rates that are higher than they were before. So why is that? And it's because they want to crash the economy, I think. Maybe not a full crash, but they want to hurt this economy down so that they can slow it, so that, like you're saying, it doesn't catch on fire again and everything just shoots back up. They want that stability for a good period of time before they, ramp it back up.
Yeah. And I think it's more of a reset, right? And for a while, they had such tunnel vision of 2% that it was like, who cares what happens outside of this? But as it's happening, we're seeing things, self-destruct on the outside to where now they're saying, okay, we need to, figure this out. Because the idea is to aim for the 2%. But at the same time, you got to see what's going on around you. You know what I mean? Because 100%. Even as an industry, we evolve. We make with the time, right? Like with builders and buying down rates, mortgage companies lowering margins to keep rates lower. So it's like we're at an inflection point where it's like, all right, can we keep this going? And I get what they're doing, right? They don't want to pivot in the opposite direction and lose out on all the progress that we've made so far. So it's kind of like, let's find our ground. And then that's why now the goal is no longer the 2%. It's like, okay, we don't want to keep this tunnel vision and just everything else destruct, right? Now it's more so, let's see what's going on and let's pivot accordingly, right? So what were they saying is a soft landing, and we may be able to achieve that because we have not seen a crash. We have not seen prices drop because there's just no inventory, right? Because rates have made it more difficult to people that would otherwise sell. The big seller right now is new home builders, which they can't build them fast enough because the resale market is just not quite there because it's very difficult and hard to fathom to leave your 3.5% interest rate to go to a 7 or an 8.
Why would you do that?
Why would you do that?
This house that I have here now is you would buy half of the house for the same payment.
Exactly.
It's crazy. So check this out. I thought this was pretty funny, this article here. Mortgage application activity hits 28-year lows. This was on September 6th at 9:36 a.m. Mortgage applications declined to the lowest level since December of 1996, despite a drop in mortgage rates, right? So we have this article, and then literally the next 8 hours later, Wednesday, September 6th, 4:49 p.m., highest mortgage rates in more than a week. So there was literally an article at 9:30 that morning saying that mortgage rates have come down. And then 8 hours later, or whatever it was, there's an article saying that they're the highest that they've been. So I think that's interesting. It's a testament to what the market has been doing. Because one day we lose 50 basis points, which in a nutshell, let's just put it in cost terms. Let's say for a cost of a mortgage, let's say we lose 1 basis point and it's a $400,000 loan. That could be $4,000 extra cost to the client for that same rate.
1 point, yeah.
Yeah, just to kind of give an idea of what that looks like. So one day we lose a basis point, then we gain a basis point.
Or 100 basis points, yeah.
100 basis points, right. And
so 100 basis points would be the equivalent to 1%, right? So if you had, let's say, for example, a 6.5% interest rate and the market shifts 100 basis points, that same 6.5% interest rate will now cost 1% more to get that same rate. So if you're talking about, like Corbin was mentioning, a $400,000 house, if the market were to shift 50 basis points, that would be 0.5%. It would cost you $2,000 to get that same rate the following day. So that's how much it's literally moving to where in one single day, it can move $4,000 if it moves 100 basis points. So at that point in time, you go to that next highest rate that doesn't cost you as much, which could be 0.5% higher. So now you're talking about like a 6.99% interest rate.
Right, dude, you articulated that very well. Love it, dude.
Mm-hmm.
So I pulled up the mortgage rates of what they were today, and I like using Mortgage News Daily. I send these out on my weekly updates or bi-weekly updates going over the market. And the reason I like using this as opposed to just quoting my own rates is because this gives you an industry average and it's not a teaser rate. You have a lot of online lenders, even local lenders, that send out BS rates that are not real, and they just send them out as a teaser to try to get people in the door, right? When I use this, it shows nationwide of what loans are actually doing nationwide with every company. So we have our 30-year fixed at 7.29% average, 15-year fixed at 6.67% average, 30-year jumbo. This one's a little bit high because, there's different jumbo products that are a lot cheaper than this, but average 7.33. 5-1 ARM 7.05. 5-1 ARM is basically an adjustable mortgage, 5 years fixed, and then adjusts after that. 30-year FHA 6.77 and a 30-year VA 6.80. What do you think about that, man? Where does that put pricing affordability for people buying a home? If they're buying, I should have calculated it out, but if they're buying, let's say, a $400,000 home, where do you think that puts their monthly payment? We can calculate it right now.
Let's calculate it.
Let's calculate it. Let's take a look at it.
It just depends, yeah. Mm-hmm. So, well, like you were mentioning, and like we were talking about a little while ago regarding, what we've found is that it's where we're healthy is more in that 6% range. And it looks like, based on what we're talking about national averages, our range is over 7%. So that does make affordability pretty difficult for the average American right now. So what do we need to do to kind of even the playing field and get those sellers to sell? Right. And what we've found from builder data, that 6% range is kind of where we need to live, and it would preferably be 5. But
5 is gonna. I mean, that we'll talk about that in a second, because the market. I mean, we have no inventory, and people are still buying. It's going to get crazy.
We just have to figure out a medium, and along the way, that's the difficult thing, is find that medium that is going to get the seller to sell, because that's just not happening. And that's what's squeezing the market so much, is sellers are just not selling. Even though they have equity, it's just difficult for them to fare, like we mentioned a little while ago, that, high 2s, low 3% interest rate to go to a mid 7.
Absolutely. All right, let's check this out. So FHA new purchase at $400,000, down payment $14,000, 3.5%. We're just going off a basic FHA loan. I'm going off of the rate here. I put 6.75% in. That monthly payment with everything included is $32.35 a month. It's mortgage, homeowners insurance at $400,000. For that same house, if you're renting it, it's probably going to be $2,200 to $2,300. So I want to give you the facts here. We're both in the mortgage industry, and we would benefit by telling you all the good things right now. But I'm telling you the good and the bad, so you can have a realistic update, and you're not just hearing from a salesperson that's in the mortgage industry. Now, here's the benefit. As I say that, here's the benefit of buying. Right, you're going to miss out on the appreciation, which I created a cost of waiting sheet here because I wanted to show that. But you're going to miss out on the appreciation, depreciation, appreciation as well. Sorry, getting all over the place here. And you're also going to miss out on some of the tax benefits of owning a home. So I wrote this down. I based this off of a $400,000 purchase here, which kind of bases the numbers. So FHA has it at $3,300. Which is about what this is saying. Conventional $3,428, non-QM, right?
And this is total payment, right? Including
total payment. And this is at 5% down conventional and a 3.5% down FHA. FHA is actually sometimes a better option right now, even with a 700 plus FICO score, because the interest rates are better. And not only are the interest rates better, the mortgage insurance is now cheaper than it used to be. It used to be higher. It's almost on par now with a 5% down conventional. And sometimes it just makes more sense to do a conventional loan or an FHA loan. Then I put a non-QM loan in here. I wanted to add this because there are a lot of people doing non-QM loans, 10% down. Rates are way higher on non-QM loans.
Tell us what a non-QM loan is.
So it's like a stated income loan, which would be a higher rate than this, or it's a DSCR, or it's a bank statement loan. Usually these programs are used for self-employed borrowers that don't show much income on their taxes, right? They just write everything off and they have no income to show. So we can actually look at their bank statements and calculate their income from that and help them qualify.
So in other words, it's a non-QM, meaning non-qualified mortgage. So it doesn't fit the standard of what your traditional conventional FHA loan. So if you don't fit that box, that does provide options outside of that.
Right. And the interest rates are higher. So the payments are going to be higher. So with 10% down, it's $3,470. You may ask, well, why is the FHA cheaper? Well, because the rate's a lot cheaper, one. But you have to reconsider that you're putting 10% down on the non-QM. There's also products 15% down to 20% down. There's probably actually very few 10% down bank statement loans. Then we have our VA loan, which honestly, VA loans are the GOAT of loans. 0% down payment is roughly $3,200 a month. This is just a rough idea, guys, on everything. You don't have mortgage insurance on a VA loan. If you may be exempt from the funding fee depending on if you're disabled as a veteran. So I like this sheet here because it's the cost of waiting, and it shows what I did is I broke it down over 2 years. Okay, so they had a 7-year option. I wanted to show because people's biggest scare right now is what's going to happen in a year or two. Appreciation, if it continues at 5%, you would roughly lose out on $23,000 by not buying a home today. You lose out on $18,000 on a conventional. You lose out on $37,000 on a VA, and around the same on a non-QM. Just an appreciation. right? So if you want to tap into that a little bit, people maybe don't understand that. Rates are high, payments are high, but if you can make it work, you're going to win long term. And this isn't even considering the fact that most people, depending on the market, there's no guarantees, are going to be able to refinance in a year and a half, a year maybe, to get their rate down.
And a disclaimer to that would be like, if I had a crystal ball, I'd be rich, right? If I knew the future. But from what we've been seeing even now, is supply's tight, right? And even if we start seeing rates drop, we may start to see some sellers come out, but they're not coming out of the woodwork. And they're not, they're not going to come out like, hey, now everybody's just, if we drop down to 6, we may see some, especially the ones that have to, because those are the only ones that are selling right now, those ones that have to, or have to make some changes. Maybe they're getting an increase in family size, job relocation, things like that. But unless we see a big change in that resale market come out, and builders, like I said, they're not building them fast enough, prices are going to continue to increase, right? It's simple supply and demand, right?
And that's what it's based off of too, right? It's economics 101.
Exactly.
So, and that's what people miss is, interest rates are high, so the market's going to collapse. Yes, if this was 2008 where we had a shit ton of inventory and the rates are as high as they are now and the demand has dropped as low as it's gotten now, we would see a collapse. We would, in my opinion. But there's no inventory, so...
Yeah, and that's why there's been that need to continue to raise the rates to tame the buyer, the amount of buyers that are wanting to go buy, because there's just not enough. So the more that they raise, they're trying to kind of weed out some buyers to kind of even things out. And then hopefully once we kind of get to where we want to be, the progress that we've made, we'll start to calm that down. But with that, we may see some more, as rates start to come down, we may see some more sellers. But with that, we will also see more buyers. That's why it's difficult to really notate that we will see prices to drop anytime soon.
Right. If it's the right time for you to buy, it's the right time for you. And you always say that, but it's the truth.
Yeah, it's one of those things where you evaluate, because everybody, we get that question often. Is it a good time to buy? And the good time, at the end of the day, if you're purchasing the home, and if you're looking at it from an investor standpoint, it just depends, and there's different reasons and ways, and we've discussed that in previous podcasts, of why or when it's a good time to purchase investment properties, flips, and things like that. And there's ways of getting them wholesale that does make sense now, even in this market. But at the end of the day, it's a good time to buy when you look at your financial situation and you have, because you're going to live in it, right? If the idea is, hey, I'm moving my family in here, this is going to either be our forever home or it's going to be our home for a good while, because we have, we need more room. Either we're renting an apartment or renting a home. We need a bigger house because we're having more children in our family, or families growing, or moving in in-laws, and that's becoming another big thing. I know a lot of builders have been creating the I guess you could call mother-in-law suites in the home, to where you can actually share the expense of
well, it honestly helps it make more sense too, because
exactly.
And not everybody's going to do this, but you could take the mother-in-law suite, if it has a kitchen, if it has the whole setup, and you can actually rent that out to help with your mortgage if you want to. Yeah. Right.
Or you could split it with a family member or an adult child that can contribute to, or I wouldn't call them child, an adult, son or daughter, that can contribute to that mortgage payment, that can make that payment a little bit more affordable.
That makes a lot of sense. It makes a lot of sense.
Exactly. But to kind of finish off on the point that we're making is that if you look at your financial situation, and it makes sense, and you can, stroke the check for the monthly payment, then that's when you're ready. Otherwise, we've had people, I know, even in 20s, in the early or the mid 2000s, when we had people, saying, hey, 1,300, 1,400 is way too much. Well, get in when you can. And that's kind of what we're seeing.
So median home price, I have a real estate report card here, and we'll finish this up. Median home price, $401,460. Average price per square foot is $269. If you're in Fresno and you're a realtor, this may not be exact. This is pulled from a mortgage company, nationwide. So they may not have exact info, but it gives you a rough idea. 5-year gain. So if you were to buy today, and here's where people get it wrong. I'm going to wait 2 years. I'm going to wait 3 years to buy. Well, let's look at 3 years, because that home is now $458,000 if we continue on the same appreciation path. In my opinion, I think rates will come down in a year or two, and when that does happen, we're going to see appreciation freaking skyrocket again, because if we're at a 5% rate, dude, that demand is going to skyrocket. We saw it at 6.5 and low 6s. If we were in the high 5s, mid 5s, or high 4s especially, you are going to see appreciation go out of control again, in my opinion. Don't, like Ernesto said too, we don't have a crystal ball. I could be wrong. This is just purely my opinion.
And based on the data, right? Based on the data and what
data.
And I always say that is that I'm basing this on what the current experts are stating and the data that's out right now. Because again, if I had a crystal ball, I'd be rich. But
And the thing is too, we look at all the information and we're the experts of our industry as well. So we can create our own opinions on what we
based
think
on
is
what we're
gonna happen. Exactly. 5-year gain, $97,000. That home is now $498,000. So in 5 years alone, you are up basically $100,000. Now, Ernesto, what does that do to your monthly payment? Every $10,000 is about $50. So what does $100,000 do? About $500, $600 in your monthly payment, right? So let's say you wait 5 years, you're $500, $600 a month for that same house, just right there alone. What does a 1% rate do in the monthly payment?
Goes up. Yeah.
Goes up, but what, maybe $200, $300? So let's talk about year two. Year two's, let's say 2 years away when rates come down if they're lower. Let's say they're 1% lower than where they're at now. That home is now $441,000 from $401,000. So you're up $40,000 roughly. You're up about $200 in your payment just for the house, not considering rates. Let's say rates came down 1%, so you're saving $100 a month maybe because your rate's down from when you bought it, but you're buying the house at a higher price and you missed out on $40,000 of appreciation of the property. See, this is why we have to bring the actual numbers to our clients right now, because there's a lot of fear in the market. And I've been sitting down with a lot more clients than I ever have in the past. You know my system. People come in, they get pre-approved with my team, and then I've been meeting with clients to explain this and show them the actual numbers in detail so they can actually make a strong financial decision.
And it's been happening thus far. So if you look at year to date or last year to date, that is exactly what's been happening. Especially when you have what does Logan Motoshami, who's the head analyst for Housing Wire State, he calls them the market crash boys or something like that.
Right.
Yeah, everybody wanting that to be the case, and we have just been seeing constant appreciation. So again, like we were mentioning before, if you're in a financial situation to buy, then this is the right time to buy. That's the right time to buy. Go ahead.
And hindsight is 20/20.
Exactly.
When I bought this house, people were telling me not to buy it.
When I bought my house,
rates were at 3%, and people were telling me, don't buy it. The market's going to collapse, yada, yada, yada. And we did for a minute. When the rates started going up, we did lose about 5 to 6% in value. But we gained all that back this year as the market kind of settled down, right? That's just Fresno statistics. It could be different nationwide. Fresno was a little bit different. Yeah. So, yeah, it's if it's the right time, it's the right time. But you want to consider all the numbers and really look at it from a financial and logical position, because if you're looking at it from an emotional position of what you're seeing on the news, what you're hearing with interest rates, you're going to let yourself down, right? I have friends and buddies that were buying in 2020, 2019. I still don't think they own a house. They were going to buy a house in 2019 or 2020, and they said it was too expensive.
Yeah.
At the time. That house, because of 2021, is now probably worth $80,000 to $100,000 more. And on top of that, they could have had a 2 or 3% rate.
Yeah.
So that payment at the time for a $350,000 house, which was a nice house at that time, would have been what? $2,200, $1,800, probably $1,800, $1,900.
About like $2,000, give or take.
$2,000.
Give or take, depending on their situation, yeah.
Right. And now that same house is going to be $3,500. So, of course, we don't want to talk about the past. Hindsight is 20/20. It's about getting into real estate and then holding. That's really the end of the story.
Especially if it's for the long term, right? If you're looking to say, hey, this is my forever home, or I'm going to be here at least, 5, 10, 15, 20 years, then, you're going to see appreciation. I mean, that's just statistically and historically speaking.
100%.
And yeah.
Dude, I appreciate you coming on. Hopefully this market update was helpful to you guys. I know we got a little salesy at the end. We weren't trying to. We're just passionate about what we do. We've been doing this long enough that we've seen people accumulate equity. We've seen people win by owning homes. So it makes me passionate to do that, to see that, and sometimes I can get a little fired up. But I appreciate you all watching. Ernesto, thank you for coming on. Do you have any last notes that you want to leave them with?
Yeah, definitely. So I think the one thing that I do want to leave you with is that every market's different, right? Overall, we did speak on more of a national level. So it would behoove you to speak to your local real estate professional, whether that be your lender, whether that be Corbin, myself, or other great lenders in the area, great realtors in the area that can kind of, get you up to date with what's going on in your current market, that would be really good to kind of get a better idea of what's actually happening specific to your market.
100%. Thank you guys for watching. Talk to you next time.
Okay.